Hi, I'm Pattu from freefincal, and today let's talk about concentration risk in index funds, where you can see that the index portfolio is heavy on just a few stocks, and the returns are governed by just the movement of those few stocks. Before I begin, I have just published the Nifty 50 stocks, their weights in the Nifty 50, how the Nifty 50 is calculated, and so on. That's the latest post at freefincal. I just published it now. You can have a look at it. I want to keep updating this on a monthly basis as and when possible. And I had talked about the basics of a seminar on the basics of portfolio management and how to construct a long-term investment portfolio. If you have not yet registered for that, you can register via this article on concentration risk. You can see that link there. You can, once you enter your email, you will be automatically sent the link for that seminar, and it tells you the basics. It's meant for people who don't know anything about investing. It's the complete basics. It's available in English and in Tamil. So now if you look at the Nifty 50, just 10 stocks make up 62.7% of its total weight, and just 10 out of 30 Sensex stocks make up 71% of the total weight. Even in the case of S&P 500, the problem exists. It's got 500 stocks, but the top 10 accounts for 27.1% of its total weight, and these are 500 large cap. If you take Nifty 500, Nifty 500 is not the same as S&P 500. Please recognize S&P 500 is 500 large caps. Nifty 500 is 100 large cap plus 150 mid cap plus 250 small cap. So in the case of Nifty 500, that just 10 stocks make up 43.72% of the total weight of the Nifty. So of the Nifty 500, basically they're more or less the entire tradable stock universe for mutual funds. So so you can see the difference in out of, there are 500 large caps, but there are only 500. Basically the total stock universe in the NSE is just 500, and that accounts for 43.72% of the Nifty 500. So the question is this is definitely a concentration risk where the returns are governed by just a few stocks. If those stocks get into some kind of fraud or insider trading or some kind of problems, then those stocks will fall by a big amount, and then the index will be in trouble. The index investors will be in trouble. That's a fact. There's no denying that. But the question is, what is the alternative? I mean, you can't just run away and say I'm going to put my money in the equal weighted indices. There is a Nifty 50 equal weight, Nifty 100 equal weight, but the risk there is extremely high. You can see how different. I've just talked about the market imbalance, how different the Nifty 50 and the Nifty 50 equal weight indices have evolved over the last couple of years or so. So those are extremely high risk in terms of, because the returns are not governed by any single stock, and then if you have a lot of duds in the portfolio, then the index will not go anywhere, and that's what's happening now for both cases. So please do not invest in the Nifty 100 or Nifty 50 equal weight indices. There are two indices for the Nifty 100 and at least one for the Nifty 50 from DSP, if I'm not wrong. I'm not saying to invest there. Don't invest it. That's heavy risk. So basically, the typical passive investor has to choose a market capitalization weighted index, and a market capitalization weighted index will always have this kind of weighting concentration risk, weight associated concentration risk. So the question is, okay, if I say I'm scared of this and I want to go to active large cap funds, is the situation better there? And the answer is not really. If you look at the active large cap funds, so I have tabulated the weight of the top 10 stocks, and this is the weight of the cash if it is in the top 10, if it's a top 10 holding currently. And these are the number of stocks that are different from the top 10 in the Nifty and Sensex. And this is the total number of securities. So if you look at HDFC's index, that's an index fund, and it's got that 71% weight in the top 10. This is Sensex has got 71% weight. The Nifty has got 62.7% weight. If you take a look at HSBC large cap, the top 10 has got 62.3% weight. Again, there is a concentration risk, and only one stock is different from the top 10 in the Nifty or the Sensex. Remember, top 10 in Nifty or Sensex is identical. Weights will be slightly different, but they're identical. Axis Blue Chip 61.5% weight, and there are only 2 stocks which are different. And in the case of Franklin Blue Chip, there are 7 stocks which are different, but still the top 10 constitute 61%. And then it's like kind of goes down a little bit. You can have the full list here. So about anywhere between 10 to 20% the concentration risk is lower in an active large cap fund. But does that mean they are able to beat the Nifty? Does that mean lower volatility or not? At least going forward, this is something active large cap investors should keep an eye on. And if they have to justify the additional expense ratio, then this is one way to do it. If you say I'm scared of the concentration risk, the so-called index bubble, although it doesn't exist in India, in the case of Nifty and the Sensex, and you say I want to avoid that, but if you want to stay invested in an active large cap fund, then there must be a return benefit, there must be a volatility benefit, and the concentration risk has to be kind of lower, and at least the stocks should be kind of different. See, at least in the case of Franklin Blue Chip, they're trying to do something. They have 7 stocks which are different from the top 10. Their top 10 is very different from the top 10 of Nifty and Sensex. But in the case of most other active large caps, there are only 1 or 2, 3 stocks different, not very different. So this is something that you will have to consider and take a call. If you are worried about active large cap fund performance and want to shift to index funds. But in the case, if you are an existing Nifty, Sensex, Nifty, Next 50 index investor, you don't have to worry too much about this concentration risk, because the argument I can say is these are very big companies, and if these companies fail, then typically it means the entire market will go down. And so that argument is always there, and so you don't need to break your head about it. Please don't go and invest in equal weight indices. That's extremely risky. So that's what I wanted to say. Register for the seminar if you have not done, and watch it over the weekend. Thank you. Bye-bye.